Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In this episode of Exposed by Math, I'm going to cover the paradox of wealth and really focus on the ROI, the return on investment. What are the differences between how a rich person needs to invest versus somebody who's not rich? Here's my standard disclaimer for Exposed by Math. If you need to watch it again, go ahead. So what's the difference? So have you ever heard of these sayings? Lottery is a poor person's tax, or most people have XYZ as an investment. The most common one is something like a business, real estate, maybe even hey, rich people have whole life insurance or something like that. The other way is I don't need to invest in that. All I need is a guaranteed 4% rate of return to be fine. Or somebody may say, I don't worry about fees. Whether I pay 1 or 2%, that's fine with me. Or you hear a statement like, hey, I need to find the next 10 bagger. So I want to address some of these things of what these things mean. And when it comes to investing, there is a different mindset. A lot of it depends on where you are at in the wealth spectrum. And for example, when you have very little or almost nothing, you need to hit a home run. You need to invest and find the next Amazon. You need to find that needle in the haystack. This is what leads people to the lottery mindset, or a mindset of you need to find something that will 10 bag your money or 100 times your money or something like that. The rich people actually have a very different mindset. It's actually, how can I make money that's protected, has very little volatility, doesn't swing up or down a lot. It's pretty boring, maybe even the fixed type income, and that's what they do. The other mindset is most regular people, we're okay with paying taxes. We're happy with 10%, 15, 20% taxes. We're fine with that. Some rich folks, they try to avoid paying as much taxes as legally possible. They hire a team of advisors and experts to help them. And this is the reason why some people get into real estate and developer. If they can write off everything, or there's ways to structure their businesses where they don't have to pay taxes, that's what they're going to do. Think about this one. What's the saving rate? If you saved 1 or 2% from your income, would you ever make it? The only way you're going to make it is you need to save 10%, 15, maybe even 20. Some people on the poor side, you need to save 60% or 50% to make it, to get out of the rat race. The rich people actually don't even need to do that. In fact, there's a reason why most of their money don't come from income. But if they do have income, they don't need to save a lot. Because the reason is, look at how many people get options, or their income is structured in a very different way. Most regular people, middle class people, don't have access to RSUs, or you only get RSUs once when you sign on. You don't get form of stock equity every year. At least a lot of people don't. The higher up you move, and even in corporate America, that switches. There's reason why CEOs can get $1 in salary and $50 million in stock options. You want less money to come from an income, which is taxed differently from the way stocks are taxed. And here's what I want to address. Does a rate of return really matter? When you're in the middle class, it matters. When you're in the lower class, it matters. You're always constantly trying to chase returns, because most of you know what I'm talking about. When you have a Robinhood account with $100 in there, the last time you doubled your 100 and went to 200, it wasn't enough for you to retire. So you're always constantly going for the big returns, adding more risk to your portfolio. And over time, that's like the guy at the poker table or blackjack table that says just go all in every time. So when I have $100, I go to $200 in tokens. Hey, I made money, and at the end of the day, I have $5,000 in token, and I'm going all in. And you only need one bad hand to wipe you out. The rich person doesn't have to chase ROI. In fact, he's playing the opposite game that you're playing. He only has to get very small returns. And this is why there is a difference in mindset. There's a paradox. You think we're playing the same game, but they're not. So what's your target? If your target is way above 10, 20, or 30%, then there's a reason why you're taking way more risk than you need. A poor person is always constantly putting himself at a higher risk. The rich person sometimes only target 2%, 4%, 5%, 6% rate of return. And this is where sometimes there's a disconnect. People think poor and rich people target the same rate of return, and that's not true. So let's talk about this. If you invested in Bitcoin this year, you know what I mean. There's a lot of middle class, poor folks who are investing in Bitcoin through their Robinhood account or whatever account you're using, Coinbase. You got 1,000 times return this year. But are you able to retire? Very few people are. There are some people who became a millionaire just on Bitcoin or Dogecoin this year, right? But the problem is you take way more risk than you need. Rich people may invest in something like a business or a real estate portfolio or things like that. What else is the difference? Well, we're taught to think about buy term insurance. Rich people generally don't even like term insurance. They buy whole life insurance. And there's a reason for that. Anybody who sells whole life insurance can tell you what's the average rate of return for whole life. It can range anywhere from 4 to 6%. So that fits under this category here. And there's a lot of other reasons. Guarantee, death benefit, tax-free, exactly what we were talking about up here. So this is the reason why. And what's the summary? This is hard to do consistently. If you're always looking for the next Amazon, if you're always looking for 20, 30, 40, 50% rate of return per year, it's hard to do. It's much easier to do something like this, where you're only shooting for a low rate of return. Now, I'm not saying this is going to work for the poor person. Like I said, I gave you an example where you only have $100 to your name. If you get 2% rate of return, that's useless. Okay, so let's go show you some of the math. So if you're making $50,000, let's look at this color here. So what I wanted to show you is if you're saving very little, like let's say the average person can only save 5%. What if, right, let me show you this scenario. If you were saving 5% and you were earning 2% in your bank account, this is how much money you will have using a formula. This $2,500 per year times 10 at 2% will only make you $27,000. So obviously this is not going to work no matter how long you're looking at. You can't save your way to wealth. So if you increase this even to a market rate, you see even that is too low. So what's the only way a person who makes $50,000 who saves very little, how do you make money or how do you build wealth? So the only other formula you have is what? You increase your risk and you're saying, well, my goal is 20% a year or 30% a year or whatever it may be. So I'm going to invest in Bitcoins. I'm going to invest in a lottery ticket. I'm going to invest in something that's super high rate of return. This is why some people get into day trading, options trading, and other stuff. They're looking to chase this number here. How do I get 20 or 30% rate of return? And if you can see the math, even at a low saving rate, these are the numbers you can hit. But what's more typical? What's more common is, and again, let's just play with the numbers. What if you have a high saving rate? Somebody who saves 15% is like the Dave Ramsey mark. And if you go for market average, Dave Ramsey uses a 12% rate of return. So if you have a typical high saving rate, 15%, 12% here, here's what the numbers look like. And you see in this category, your rate of return is still better than this guy, or total net worth, because you're saving more. Out of your 50, you're saving 50%, that's $7,500 per year. You only need a lower ROI to hit these numbers. And so this is more logical and reasonable. But if you're above the Dave Ramsey, right, if you can save a little bit more, well, you know what, let's leave this as Dave Ramsey, and we'll show you that. And then here is the fire people. I made a bucket for that. Let's just say you're in fire. Some people have 35% saving rate, so that's $17,000. And let's assume fire people are not going to invest in low risk. Let's just use 9% because that's like the S&P average. Whether you use 9, 10, or 11, S&P average is around 9%, 10%. And you see how fire people in 10 years can accumulate quite a big difference compared to this person or this person. And this is why rate of return matters. But let me show you, it's the same concept. So let's just make all the numbers match. So let's use 12 here. This is the Dave Ramsey guy. This is the FIRE guy using 9%. And really, some FIRE people are up to 60% of their income or 70% of their income is what they're saving. But I wanted to show you this so that you can see how rate of return matters because you don't have a lot of money. As you have more cash, you don't really need a higher rate of return, right? What you need is the capital. Now, that's how me and you do it. At some point, when you have a large net worth, your rate of return on your investment actually surpasses the amount that you're putting in new contribution. So if I'm only saving $5,000 a year, and if my portfolio is generating $10,000 return every year, like in dividends or in other forms, then you can see how your portfolio now becomes much more of an influencer on my net worth, not necessarily my income. So therefore, at some point in my life, my income doesn't really matter. What I save doesn't really matter. It becomes how I invest it. And so market risk matters. I want to show you what a millionaire worries about. And here's the numbers for the millionaires. I want to show you the difference. So this is what I want to show you. A person with an $8 million asset, even if he invests at a 3% rate of return, this is how much they make per year. That's clearly more than 80% of Americans, maybe. I don't know the exact number, but you can probably check in the IRS income bracket tax return. But I wanted to show you this. An $8 million portfolio with a 4% rate of return is $320. 5% rate of return is this. And if this guy doesn't want guarantee, he can put it in the stock market for about a 9% rate of return and make $720,000. At $15 million portfolio, he can buy something that's guaranteed, making 3, 4, 5%, and look how much money they make. And I wanted to show you this in a $25 million portfolio. This is sort of the beginning of the ultra net worth, high worth individual. Guaranteed rate of returns, you can go for something really boring and still make $1 million a year. Put it in the stock market, you can make $2 million a year in typical rate of return. And now you're getting into the really wealthy $100 million. Boring stuff will generate this much per year, 9% in the market. And this is a guy with $1 billion. You add another zero to it, $30 million, $40 million, $50 million in boring investments that have zero risk. Or stock market is $90 million. So what does that all mean? Whenever you hear somebody say something like, Warren Buffett don't need Bitcoins, or Warren Buffett doesn't like Bitcoins, or no rich person need to invest in Bitcoins. Well, part of that's a true statement. A rich person don't necessarily need it because they can make more money buying government bonds. They can buy something that's fixed rate of return. They can buy a whole life insurance and do perfectly fine. But I also want to be able to be honest on both sides of the argument. Whenever an insurance agent tells you, hey, rich people always buy whole life. Well, that's true because they don't necessarily need 8, 9, 10, 12, 15% rate of return. When you're on the broke side, doing a 2 or 3 or 4% or 5% rate of return is not enough for you. And so until you get to that point, or if you can predict that you will be in that point 20 years in the future, you need to do some planning and figure out how to plan for that. But this concept of, do they both invest the same way? And the answer is no. And this is why most people have a hard time understanding this concept. So when I first started out, I did chase returns. I was in this side. I wanted to trade and make 1% a week, which is insane. And I did it successfully for a couple of weeks. And then guess what happens? You take way too much risk and you lose. Then you adjust your strategy and you try different things. And guess what happens? When you have that poor mindset, I go back and I make the same mistakes again. Now what I have done is, as my wealth built up, I realize my retirement is not dependent on getting a 20% rate of return. In fact, it now becomes lower and lower. My retirement or other things that I set for myself now requires a 6 or 7% rate of return. And as you go and move from this mentality to this mentality, I don't need to chase 20% returns. In fact, if I chase something like this, you'll be perfectly fine. And this is the hardest part of the thinking. So there are ways to plan for it. You can model out your future. You can project where you're going to be at. And as a financial coach, it's one of the hardest things to do is to try to predict with 90% certainty where you're going to be, because it explains how you should structure your investment strategy. It doesn't mean I'm moving everything to fixed bonds, or doesn't mean I'm investing everything in a certain business or whole life, but it does make sense to start looking at it and planning for the future. And then the next concept that goes hand in hand with that is asset allocation and diversification. What most people who start in this side, what ends up happening is one or two assets become the biggest part of your portfolio. And for most people, it generally is your 401k plan or maybe even real estate. And when you get to the point where you're in the multiple millions, you realize you have way too much risk in one asset class. And the whole purpose of trying to remove risk is not to have an asset that can drop 30 or 40%. Real estate did that recently. Stock market did it multiple times in the last 20 years. So part of the investment strategy for wealthier people is to do what? You want to smooth out those bumps. And so there are ways to do that. This is the reason why people introduce things like annuities into their portfolio. This is the reason why people introduce whole life insurance policy for that reason. You can remove some of the risk or transfer the risk to somebody else, and then you can smooth your rate of return in your personal portfolio. And this is something that, again, depending on where you're at, is whether you need to think about it or you don't need to think about it. Sometimes you're in the middle, and depending on what happened in life, you need to consider where you may be 5 or 10 years from now. And this is why there's no one fixed answer for everybody. Don't trust gurus that say only one thing or the other. There is a concept of your mindset switches, because when you're dealing with $100 million, you don't want your portfolio to drop 50% next week and be worth $50 million. It just doesn't work that way. Most people understand they just want to beat inflation. Everything else is nice. They know they're never going to spend all their money away. And then the last piece is, why is it hard to do? If you're shooting for a high mark of high rate of return, you're taking way more risk than you need to. And this is why it's hard to do. Can it be done? Sure, but it's an outlier. It's a small percentage of the population in this category that will hit, let's say, a 15% rate of return for the next 10 or 20 years. Very hard to do. And so what that means is you generally take way more risk than you need to, and some of those setbacks set you back 5 or 10 years. I know, because I have made those mistakes, and it sets me back 5, 10, or 15 years. What I'm trying to do is change my thinking, where not only will my setbacks not set me back, by moving into this type of mindset, it's easy to do. And what I mean by that, it is easy to shoot for a 5% rate of return. In fact, I can beat that with some of my options trade. But I want to let you know, my option trade is not 100% of my portfolio. It's a small percentage. And so my rate of return can still be market average, 9 or 10%, but I don't need market average to do well. I just need 6, 7, or 8% to do well. And this is easy to do. When you're shooting for a lower rate of return, anybody can do it. The only difference is you need enough capital to reap the benefits. So this is why it's okay to be in this side, accumulate your wealth in the beginning, collect and save a lot, try to get yourself to this side so that you reduce the risk, you start changing your mindset, you're protecting your income, you're protecting your net worth, you're protecting your assets. It's a very different strategy, and this is why it works. I don't want to teach that there's only one way to do it. It's much more complicated, but it's easy to do in theory, right? The theory is actually easy. What's hard is people risk tolerance is what causes them to either fail or succeed. you have the right thinking, you can come up with a plan that's very easy to do, very low risk, very easy to predict where you're going to be 5 years in the future. Thanks again. If you like this concept, watch all my other Exposed by Math. I do a lot of interesting topics, and I want you guys to learn. I want you guys to be able to win with money. This is a mindset thing. Not hard to do. Anybody can do it. The math plays itself out. It's actually fairly simple. But thank you again for watching. Give me a like, subscribe. Stay tuned for some other episodes like this. And as always, have a profitable day. Bye-bye.